Welcome to SmithWeekly Discussions, an occasional program for our readers and listeners of SmithWeekly Research. Please note this program is a private discussion and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position, along with your favorite beverage, to enjoy the discussion. We remind our audience to examine the show notes attached to each of our shows to better understand how our program functions. Before we get into our discussion, we want to say thanks for questions coming from our audience at SmithWeekly, including Cyril O, Jared W, and Mike P. Guy Keller is on the show today. Mr. Keller is commodities analyst at Tribeca Investment Partners, an investment group based in Sydney, Australia that is focused toward natural resource investing. The company has listed its Global Natural Resource Fund on the Australian Securities Exchange under the symbol TGF. Guy, welcome to the show.
Thanks, Andrew. Thanks for having me.
Guy, give the audience an overview of your background and how you ended up being focused on natural resource equity investing.
Sure. Thanks. Yep. I've been in the commodity markets for just over 20 odd years. The bulk of my career has been on the actual physical commodity side and the derivatives of such, trading precious metals, gold and silver, trading some base metals, and the bulks, iron ore as well. I've worked in London, Sydney, Singapore, then back in Sydney, and so always had a very much sort of resource-focused career.
Tell us a bit about Tribeca, including the various focuses of the business, and then, if you would, assets under management. And well, let's go with that.
Sure. Yeah. So Tribeca Investment Partners are a boutique fund manager. We were established in 1998 in Sydney, Australia. We run around $2 billion Australian dollars on behalf of a range of client pension funds, family offices, and high net worth. We're a fundamental investor. More relevant to this conversation are our global natural resources strategies. So we run a global natural resource long, short, mainly equity investment. We do go across other ways of looking at that as well. More recently, we launched a credit version of that strategy where we're lending money at a project level in the resource space. As you mentioned before, we listed a listed investment company on the ASX last year to allow more retail exposure to our strategy. And a very busy year last year. We also then launched the Nuclear Energy Opportunities Fund as well, just to have a bit more of a concentrated approach on uranium.
Okay, well, tell us about, for a moment, how can investors get involved? Just give us an outline. You know, there's a number of international folks listening outside of Australia, Canada, North America, etc., Europe. How can some of those folks who might qualify get involved with the fund?
Yeah, so we all three of the funds are wholesale, are targeted to wholesale investors. So they do have a requirement that you are classified as a wholesale investor. The global natural resources and the credit version have Aussie unit trusts as well as offshore US dollar funds. That both do the same thing. For the smaller investor on the retail side, obviously the listed investment company that does replicate the global natural resources. It has some exposure to the credit strategies in the resources fund as well, and that fund also has some uranium positions. And then the Nuclear Energy Opportunities Fund is also a wholesale investment fund. So again, it has a minimum investment criteria, but and is a bit more concentrated, as I said.
And how has performance been at Tribeca? Anything you'd like to highlight there? And also, is there any key people at the group you'd like to mention?
I mean, we on the resources side, we're probably the largest team in this part of the world focusing on global natural resources. We do have a good track record in our flagship fund, Global Natural Resources Fund. and as I said, the other funds are a little bit newer, so they're still building some track record. But yeah, I mean, we are a pretty dedicated team to resources, and that's that's sort of not so common in this space.
And before we get into the uranium side of Tribeca, what other parts of the natural resource markets really have your attention today? And is there anything specifically outside of uranium that investors should be paying attention to?
Well, I mean, the last little while in markets globally have been pretty much dominated by macro around President Trump and China and trade wars, to be honest. We've seen a lot of noise and market direction come as a result of the back and forth there. We've seen a lot of focus on what the Fed's going to be doing and therefore what other central banks are doing. So, I mean, we're fundamental investors in the resource space. So it's there has been a little bit more noise more recently than we'd like. Obviously, gold's become very topical. It's had a fantastic price appreciation as a result of all this macro, and for us it's hard to say fundamentally why it's here. Gold, as you know, and many of your listeners know, is very much a function of geopolitical risk, of yield, or the lack of yield anywhere else, safe haven, US dollar. So there's a few of those factors driving that, but that looks pretty good at the moment. And a lot of the other commodities that we look at, they have unfortunately been tied up a little bit in trade wars. So it's a part of now being saying, well, if you do get some sort of resolution, which commodities will benefit the most to the upside as a result of that? Where's the demand? What's still looking tight? And so it's for us still a bit of an ongoing puzzle to just try to pick the timing of when we can sort of look back a bit more fundamentally and see a bit of global growth come back in.
Well, Guy, give us your view on the uranium market. What do you see happening with this sector over the next 24 months?
Uranium is one of the standouts for us at the moment, especially with respect to, as I was saying before, all the noise in the market, because we're fundamental investors, and the fundamentals make sense for us, and that is the current supply of uranium is not enough to satisfy the current demand, and the demand that's currently being built way outstrips the future or planned supply that we see at these prices. So there's a big disconnect, and which is why it makes so much sense to us, and why it made sense for us to spin out a concentrated strategy and focus on it.
And how about the Tribeca strategy? What does the company really look for when it decides on a uranium company? Are you looking at the physical funds? Are you looking at producers, developers, explorers? Give us the Tribeca approach.
Yeah, so we have the ability to look across the whole nuclear supply chain as part of our mandate. At the moment, we're very much focused on spot, obviously, and what we see as who will be first to the market. We do have a diversified portfolio approach, but we do have a little bit of concentration because our view is here that the first move in uranium is, whether it's spot led or spot reacts to it, is a move in spot, which then gives an opportunity for a handful of sort of brownfield or care and maintenance type projects to quickly come in or quickly in uranium speak is still a few years. But it's the focus on who will be first to be able to take advantage of that price appreciation before moving on to the next phase, which still has to happen because the prices will not be high enough to get enough supply in for what's required. The next phase is then, being able to have a bit more of a concentration on some of your developers, some exploration assets and things like that. So, it depends where we are in the cycle as to how we're looking at things.
Do you think there's a little bit of a hesitant nature in the market a little bit for when the price is at $35 or $38 or $42, who pulls the trigger first? Do you think that there's some itchy trigger fingers out there who just want to try to get going a little bit to maybe make a few pennies or maybe a few dollars versus those who are determined to really just hold out for higher prices? What's your thought on some of those companies maybe trying to get started a little bit early at really the detriment to themselves?
Yeah, I mean, I think the reality is that nothing really moves fast in the uranium market, and there has been a long period of time where the market has been, in a bear market effectively. So, I mean, it's natural that there will be people that are keen to get to market. I mean, the reality is though is that they still need to secure a price that's going to make them profitable so that people invest in them. It's not just, and a lot of these projects are not big. They're not able to control the market where they can say, well, I'm coming to market early so I can control volume, and maybe means that somebody else doesn't get in. None of these guys are big enough to be able to dictate that. So, as an investor, if we're looking at a project that comes in too cheaply in our mind, and is not going to be making enough profit at the end of the day, then we're not going to invest in them.
Right. And what is some of the key factors for Tribeca? Is it the management team, the lowest price as far as the equity price, or maybe even the uranium price or the all-in production cost? Is it the project? Tell us some of the key things that you really see as important.
Yeah, I mean, we approach all our resource investments on the mining side in a similar way. We're almost going through a checklist in what we look at. The reality is, I think for everybody in the uranium mining sector, prices needs to be higher. So, that's not as important for us. I mean, what we find when we look back on why things haven't worked in the past, and the good thing about the uranium market is we have had two bull markets in the last observable future, which gives us a really good precedent to go back and have a look at. And where we find that things come unstuck is with respect to jurisdiction and permitting. So, for uranium, they're the two main important things, or most important things for us. Are they in a jurisdiction that's going to be friendly and supportive and has the regulatory framework in place to allow that company to produce? And, are all the permits in place? Because uranium mining, I mean, like all mining generally can come unstuck with permitting. But uranium, there's just more of a spotlight on that. There's more steps that they need to take to make sure that they have that permit in place. So those are the two things we mainly focus on.
Okay. And do you have a limited belief that, with all these equities in the market, that there's kind of a rising tide and all boats will kind of float higher in this specific sector, or do you guys kind of don't agree with that kind of approach?
We think it gets to a point where everybody benefits, but I think early in the cycle, which is, I mean, we're still very early in the cycle. There's things take a while for the excitement and the froth to come in to give a rise to everything. So I think certainly, and again, is it a spot price appreciation? Is it announcement of large contracting? I don't know necessarily what it is that gets things moving, but I think early doors, the quality will move first, and the rest will sort of follow.
Right. No, I think that's a good idea and a good analysis of what likely will happen there. You mentioned jurisdiction. What do you look for here? I know you mentioned permitting, but what jurisdictions does Tribeca have exposure to at this point? Can you mention a few countries?
We have a reasonable exposure to Australia here. A lot of that it's in one stock. We have a fairly good exposure to Africa. I just think that Africa has the ability to move. Assuming you're happy with any geopolitical risk in Africa, but to be honest, where most of the projects are pretty reasonable jurisdictions, and more importantly, they've had a long history of uranium mining, whether it's via from the French or the Chinese or whoever it's going to be in the past in those countries. So we do like Africa from a jurisdiction perspective. Obviously the USA, there is some pluses there at the moment, especially if there's a positive outcome from the working group that gives more clarity as to what the utilities can and will do. So we do, but that's an exposure we're growing slowly. We were lucky that we didn't have a huge exposure to the US prior to Section 232, and to be honest, that was a little bit of dumb luck, but also a little bit of we just had sort of competing priorities as to where to put some money, and figured that we'd be happier to chase a bit of momentum into the US than wear some pain. So we were a little bit lucky there.
Yeah, well, no, absolutely good timing there, and you certainly have a nice, what are we at, 35-40% discount on some of the names there just over the last, 45 days or so. So that's been a good place to maybe park some potential capital there. How do you enter these positions? Are you using private placements, open market purchases, a mix of both? And is there a timing element to these different entries?
Yeah, that's a good question. One of the advantages that I have in sitting where I do at Tribeca is that we've been in the global natural resources space for a number of years in the Tribeca format, and prior to that, most of us have worked in global commodities or global resources. So we find that the access to liquidity events in the equity space, we don't have to work too hard to find that, because we're already talking to a lot of the brokers in Canada, in America, in Australia, in Europe, due to our other funds. So we do see a lot of opportunity that comes across, and whether that's private placements or raisings or whatever it is, we prefer to be able to access liquidity without having to go into the market. Sometimes we do, depending on what's going on. The reality is, as you and your listeners have probably seen, is that the market capitalization of the uranium sector is pretty small, and liquidity is one thing that compared to some other sectors is not as easy to find. So when you're trying to deploy a reasonable amount of money, having the contacts and the connections to be able to have the opportunity to participate in some of these raises makes a big difference for us.
And on the uranium fund there at Tribeca, can you share with us the approximate size of that fund?
We don't actually break down the assets under management for the individual funds, but across all our resource exposure, it's a pretty reasonable exposure. It's public knowledge that we're substantial shareholders in 3 uranium stocks, and they are reasonable positions across all our portfolios. So it's a good amount of money we do have invested in the space.
Okay, and how many positions does Tribeca see as prudent for the uranium equity side, and how many do you have now?
Yeah, on the uranium side, we think concentrate. The reality is there's not, on uranium miners, there's not that many listed opportunities compared to previous cycles. That's probably likely to change as things start improving. So we aim to hold sort of 10 to 15 positions in the nuclear fund. I think at the moment there's about 9 positions.
Okay. And what is your approach specifically on the position sizing in these different companies? What can you share with us? If you guys see, a 5% position, 10%, or how do you approach your position sizing with the type of company and your conviction level?
Yeah, that's a good question. We do look at it from a number of different angles. We break it down into jurisdiction. We break it down into, are they producing? Are they brownfield and care and maintenance? Are they explorers? Are they developers? We break down, where do we want to be heavy at the moment? So at the moment, a lot of our portfolio is in brownfields and spot exposure. And does that change? Yeah, it does. It changes as opportunities come to us. So we, for example, might not be wanting to be too heavy in explorers, but if an opportunity comes to participate in some liquidity via a raise and it's on attractive terms, then we know where we want to be and what we like. Sometimes it's just the timing might mean that we get it earlier or later than we wanted. But that doesn't bother us. We're a 3-year strategy at least. So, if we pick up an explorer 6 months earlier than we were planned to, then so be it. But yeah, at the moment, it's very much sort of that brownfield first to market and spot that is probably our concentration.
And percentage-wise for a position, obviously that's going to be variable, but is it kind of around maybe 5 to 10%, or how does that fall in?
Yeah, pretty much. Anything less than 5% in the portfolio is not really worth having there, unless it's a toehold where we're trying to build a bigger position.
Sure.
And it's sometimes the other issue I think is that because of some of the market cap of some of these companies, maybe it ends up being less than a 5% position just because you don't want to take such a big stake to be hitting a substantial threshold and having to report that.
Right. Yep. So you mentioned a couple companies. Are there any companies that you'd like to mention that the public is aware that Tribeca has? Is there anything you'd like to mention there as far as names and why you like them?
I guess it's public information. As I said, we won't sort of just talk about anything that we're not substantial in. So if anybody Googles it, they can find that we're substantial shareholders in the London-listed Yellowcake, in Australian-listed Boss Resources, and Australian-listed Bannerman. There's 3 very different approaches there in those 3 stocks. It's worth reminding people here that that's just part of our portfolio, and because we're substantial in them, that's across a few different funds. So it could be a small or a large part of the nuclear portfolio. And we're also here for 3 years. So please don't go and rush into any of those just on the basis that I said we own them. But the London listed Yellowcake it's an easy. It's like the Canadian listed Uranium Participation Corp. It's a spot proxy, and given that part of our thesis is that one of the first movers in the early stage of this cycle has to be spot. It's a good way to have exposure that you can bring up and take down, on the market, as opposed to being in physical derivatives. We do have the ability to gain exposure via physical holdings, and we are always exploring ways to increase leverage to the spot price via that. So that's a little bit of a work in progress, and I think at some stage in the future we will have some exposure there as well. Boss Resources, it's part of that sort of first to market. There's no doubt in my mind it's the first Australian project that will come to market in this first wave, and it'll be part of a small handful of others that come to the market outside of some of the bigger boys that are on care and maintenance. It's already had some sunk capex. It's low cost. It can get to £2 million pretty quickly and easily in uranium speak timelines. So that's sort of a reason we own that. And then when we look at Bannerman, I mean, people sort of sit there and say to me that the Chinese have got enough in Namibia. I've got a slightly different view to that. I think that Namibia works for the Chinese. The Chinese need at least one more Husab mine just to fuel the reactors currently under construction. So why, there's not too many other jurisdictions for them to be able to, venture into. They've been into Niger, and that hasn't necessarily worked for them. There's limited ability for them to be in Kazakhstan, and I can't see necessarily Canada or Australia with their foreign investment rules allowing them in a major way. So it's fantastic leverage to that whole sort of Chinese hot pot in Namibia.
Yeah, good luck with getting into Australia and Canada and the United States. It could be a little bit difficult. They might have to head further south and look at South America perhaps. But so you've got the Australian and Canadian dollars at a healthy discount to the US dollar. On a dollar amount basis, is Tribeca heavily weighted more towards Australian uranium stocks, or is it more allocated towards Canadian uranium stocks? Can you maybe share how much in percentage terms?
I don't have that breakdown in percentage terms. I mean, I think the factor of geography and time zone, we tend to see and be awake for more opportunity here in Australia. And to be honest, there's in Aussie listings, there are actually abilities to get Namibia, Australia, US projects. We're sort of in and out a little bit in Canada. It's a point, it's a part where we probably need to add some more exposure. There's a few things I'm looking at there that I like. I just think I've got a little bit more time to potentially be able to raise some more money and and have the ability to get in there a little bit more with a bit more weight. I don't really have that breakdown as to what my exposure is via sort of currency weighting.
Okay, and you guys do have some, I'm assuming, some TSXV listed uranium stocks?
Yep.
Okay.
Just small at the moment.
Sure, absolutely, and certainly the the discount there with the U.S. dollar. I'm not sure how much longer that's going to last before it starts to slowly move the other direction, but we'll find out.
Yeah.
So how do you look at cash as part of your strategy, Guy, and what portion of cash will Tribeca try to maintain while being invested in the uranium market, or will it kind of maybe go all in? How do you approach cash?
With respect to the Nuclear Energy Opportunities Fund, it's a concentrated investment thesis. So the cash holdings are minimal, to say the least, and often it's because we're waiting for a price point in something. So post 232, we made a decision to move a lot more heavily towards exposure, and I think that trend post working group will continue. It's coming to a point where there's just a lot of things that need to happen by the end of the year, and so we're happy to wear a little bit of volatility and noise at the moment, instead of trying to really rush in as things start moving towards the end of this year.
Right, and give us how about this though? When you have, let's say nothing happens in the uranium market, so nothing significant happens until say 2021. Let's say the utilities hold out, they drain down their inventories and their stock, and let's say 2021 comes around, and maybe we're starting to move by then, maybe 2022 perhaps. When some of these companies that you're invested in are ripe for, they need more capital, or their stock price is low, will Tribeca look to add funds to increase position and do what they need to do there, or how would that be approached?
Yeah, I mean, for a start, I hope it doesn't take till 2022 for this to play out. I hope that's a worst case scenario, but we've set this fund up to be a long-term investment strategy anyway. So it's a, if you were to invest tomorrow, it's a 3-year investment for you. Then that has a lock on it, and we've done that for a reason. I mean, the first reason we did it was because when we launched this strategy, we didn't really have any idea of how much appetite we would have for it. It started largely with partner money here and a few key investors from a larger global natural resources fund. And one of the things we looked back on in the past was, when you needed to be buying, when institutional investment strategies set up and they needed to be buying through periods of pain, often they were getting redemption, so they were forced sellers. And then in the flip side, at the top of the market, when they probably should have been taking risk down, they were getting more money in. So that was one of the reasons that we sort of said, listen, we all believe we're in this because we believe the fundamentals have to rebalance, and we don't want necessarily to open this fund up to new investors who 3 months down the track say, you know what, I don't, this isn't working, I need to sell. So that's one of the advantages that we have, is that if it does take till 2022, we'll still be invested. As for the projects requiring more money, that's sort of that's sort of a given outside of non-producers. Is that yes, there's always going to be a time where they have to raise. We look at it from a case-by-case perspective, where if we don't have as much belief that the project or the company are doing what we need them to do, then we won't participate in that raise, and we'll dilute as a result of that. And likewise, if there's a share price on its knees and the company needs some money and we're still big believers, then we'll add appropriately. So it sort of depends on what we have available to invest, where that company's at, and how far along the cycle we're at.
Right, absolutely. No, I think that's the case. If it's 2022 and the uranium price is still at $20-$25, then these stocks, you can count on much higher share counts for most of them, and also with needing, probably sentiment will probably be driven down, so you'll probably have lower prices. So I think you're absolutely right. Case by case basis, the ability to add money when needed, I think that's key. I certainly plan on that, and I think we've tried to delineate that here at SmithWeekly Research, where we maintain a balance of cash for these opportunistic situations that come up, and really taking a slow entry approach that we've tried to do here. So I think that makes a lot of sense. How about exit strategy, Guy? What are your thoughts here, and how will Tribeca approach this when the time comes?
For a start, we'll be closed to new investors well before this market has got anywhere near topping out. So that would be one of the first things you'll see us do is saying no more money, thanks, because we will. And that, as I said, that may not be us thinking that the cycle's necessarily over. That'll be us saying we've got enough invested, so that if and when we need to exit, it's not going to be one of those things that takes weeks and months because we're too big for the market. So it will be a decision on how much money we are running in the fund at the time, but also where it's at. So that'll be the first thing you see us do, because we certainly don't want to be taking in double our funds under management if and when spots at $110 and everything's ripping along, because that's probably a time we want to be getting out. As for exit, I mean, we've set the fund up as specifically to be allowed to be short as well. So we may get to a point where we decide that something's run its course, take that risk down and redeploy it into a short somewhere. It doesn't mean that the strategy's over. It just means that we might think that it is toppy. The other perspective we have is that we're owned by staff, so a lot of the decisions are our own. There's no third party, and plus, I work as well on the main global natural resources fund. So when it gets to a point where we think the returns to our investors are appropriate for what's happened in the market, then we can shut the strategy down. I don't need to keep it going to stay in a job. I've got the ability to be across the other platforms. So you won't sort of see me holding on to the bitter end because if I shut it down, I'm out of a job. There's plenty of other things I could be doing here as well. So I think that's, and we may look back on it in years to come and say, wow, we left 25% upside on the table by getting out too early. But when you look at some of the strategies that got stuck at the top last time and pretty much gave a majority chunk of what they'd have made, they gave that back. In that, not gave it back to investors, but gave it back to the market, so to the detriment of the investors. We don't want to be in that position. We'd rather an investor say, thanks very much, guys, you've done a great job, but wow, there was another 25% in it, as opposed to what were you thinking? How did you not get out?
Right. Yeah, and 25% is a small rounding error in this market. So
it sure is.
That's no problem. No, that's great. I appreciate you giving some information on that. And I want to ask you, what are you going to look at? What is going to be the gauge? I mean, people talk about looking at the individual uranium stock prices, and I think that might have a little bit to it, but will you look more towards the big market view in terms of what's going on with long-term contracting, what's going on with the spot price, rather than just looking at, hey, this one company, ABC company, has done a fantastic job. They've ran hard, but even though we've got a stock that went from 50 cents to $7, the uranium price is really only hanging out at $50. Maybe there's still some upside left. How are you going to look at it? Is it going to be more of the uranium big picture than maybe some of the individual stocks?
Yeah, 100%. I mean, that's half of the battle is getting the fundamentals right, and it's. I mean, the one thing I'm excited about already is that uranium and nuclear energy and whether it's in an environmental argument around carbon or replacing sort of baseload power or future electricity or whatever it is, there's a lot more news flow around the sector now, which and a lot more positive news flow than there ever has been from what I can see in simple searches. But so there is a bit more of awareness coming into the market now and the whole sector, which I think is great. The one thing I point to a little bit is when you look at some of the volatility in the stocks post sort of 232, which some saw as a disappointment. I mean, we see it as bullish because it allows us to, as we say, it takes the handbrake off contracting and allows the market to function properly again. I think what some of the money that was in some of those positions then, I think what they've failed to grasp is it's not a short-term play, uranium. I mean, we all hear people talking about how Paladin went from 4 cents to $10 or whatever it was. But what you've got to remember is that was over a fair amount of time, and there was a fair amount of raising that happened in the meantime, and the last move higher was the explosive part as the cycle really got going. So we're at the really early stages, and I think as some of that faster money shakes out, there is fundamental money coming back in to replace that's got a more patient view, which I think is very reassuring. The other point, I guess, is with respect to spot. Spot market's a very small market. There's a small handful of players. The best analogy, I think, when you look at real market activity is for resource investors, is to remember back to what the iron ore market used to be, where 90+% of the activity in the iron ore market was done on annual contracts, and sometimes contracts agreed, volume contracts agreed further out, but priced annually. And the spot market in iron ore back then was pretty much the clearing market of last resort. There was very little activity, a handful of players. And I think that's what you've got to remember is where the uranium market is that the real activity happens in contracting. Whilst there's been opportunistic activity from utilities more recently in the spot market because of the market dynamics, what dictates where the spot price is going to be is very little activity. But there's a lot of eyeballs that focus on that. That's the reference point because it's an investor can't just go and say, hey, where's that utility RFP? Where did they price it? There's not that visibility. So by default, you go back to the spot market. So it is important to watch that. But I think to your listeners, it's important for them to understand that it's being controlled by a small number of people. As we saw last year, when the momentum on it moves, it can move very quickly. So, it went to $29.10 in a pretty short period of time to end the year, and just as quickly it came back to $25. So, that moves, which gets people's attention, which is why it's important to keep an eye on that. Because then, obviously, when you then turn around to the stock point, people do analysis. They agree a thesis, but what's the catalyst to get them to come in and buy? And it'll be something like a spot move that will get them to come and buy. Wowee, uranium spot price is through $30. What's $30? It's just a number, but it's where it sort of failed before. Wowee, it's through $30. Those uranium stocks that I was hearing about on the podcast, or I read about on the research report I got, maybe I'll go and buy those now, and then off it goes.
Well said, and appreciate you giving your thoughts on that. And certainly long-term and spot need to be watched, and they both have different characteristics that I think play into how the health of the market is. Like, for example, a divergence, a heavy divergence in these two price points can also start to indicate certain things. So it's key to look at, and absolutely the long-term contracting market is the place to be.
And even when, just to add to that, I mean, even when you're looking at, at the conversion and enrichment prices, which are not as easily observable to most people as the spot price is, but they've been rallying, so you have seen a real disconnect where the spot price has been selling off, but the enrichment conversion prices, so, the next stages in the uranium fuel cycle from just the uranium as it's processed in to become, fuel for the reactors, that's telling me that real activity is picking up in the market, that the spot guys are mucking around trying to play silly games with the spot price. But the real activity in the market is actually, the market's getting on with it. The market's realizing that it needs to be moving forward. And you've seen that in the conversion and enrichment prices.
Yes, absolutely. No, SWU and conversion is key. A separate piece to be watching, but absolutely those are additional pieces that need to be looked at. And I know you and I only covered not even half of what all the things we should be looking at, but we would take another 30 minutes to an hour to touch on those. Yeah. Right. Absolutely. Well, Guy, how should investors considering Tribeca, what would you say to potential investors who might be listening to this?
The one thing that, one of the many things we do, I mean, we are resource specialists. We've done the work. I mean, when we talk to potential investors and current investors in our fund, people obviously like the story. They tend to agree with the idea of the fundamentals that the price has to go higher. But reality, if you're looking at a concentrated investment strategy like ours, you really, you don't. I mean, it's volatile, right? There's a lot of noise in it. You really don't want to be investing the majority of your wealth in it. What you actually invest is up to the individual investor, obviously, but it's maybe 5 or 10%, say, for some of these family offices and high net worth. And so our argument to them is, why would you do the uranium market it's small, but it's fiddly. There's a lot of moving parts. There's a lot of things that you've got to go digging for. There's some of these companies have been in bear markets for a long time. They're really good at promoting their story. There's you've really got to spend a lot of time just trying to work out where you need to be in this space. So if you're an investor looking to put 5 or 10% into this into a uranium strategy, the amount of work you have to do is a lot more. It's not just sitting there saying, hey, I'm going to go and have 30% of my portfolio on financials because I got a view on X, Y, and Z. It's very it's very nuanced in uranium. So we do the work. We're specialists in the field. We're looking at everything from both an equity perspective and a debt perspective because of the credit fund we have. So we're looking outside just uranium miners as well. Like, are there reactor engineering companies that might be good to own through the China build cycle, things like that? Is there nuclear medicine technology that may be an investment opportunity? So we're looking across all of that, and we're tying. We're here for the long term. As I was saying before, it's a 3-year plus strategy. So we don't have the problems that some others may have of investors wanting to get out, and so you're forced sellers. We're only going to be buyers until such time as we stop buying.
Right. No, I think that's a key piece, and for certain clientele, I think it's also interesting to look at because you guys really offer now with the listed vehicle on the ASX. You kind of are out there competing with maybe the Geiger counter in London and maybe some of these other listed funds out there, maybe even to some degree taking away some of the physical fund investors that are looking towards, they want to have both the physical, maybe a yellow cake, but they also want to have an equity fund, and Tribeca kind of fills that piece. So I think that's a key part that people should remember. How about how can folks reach out to Tribeca or to yourself for more information on the fund and to connect?
So we have a website. There's a lot of information on the website, www.tribecaip, IP stands for Investment Partners, .com, and contact details are on the website.
Well, Guy, I really appreciate you coming on, and we appreciate the time.
Andrew, thanks very much for having me. It's been really great. Thank you.